Is there a right way and a wrong way to retire? Welcome to Retirement Revealed. I'm your host, Jeremy Keil, and we're here to turn your retirement savings into retirement income. Today, we're talking with Brad Barrett about how to secure the right path to your retirement. Brad, welcome to the show.
Oh, appreciate having me on, Jeremy. Thank you.
Well, tell us, Brad, what is the right path to secure retirement?
Oh, every path's different. I'll tell you that. I think in 19 years of doing this, you find that I'm sure you have in your practice. I think the biggest thing we as advisors do, and one reason I wrote the book around it is kind of the connotation of that not every path's the right path, and not your neighbor's path may not be your path. And so I think having counsel and having that advisor be with you to kind of help you guide that along, steward it for you, and with you is key to the success of whatever your finances, successful journey looks like. So it's kind of one of the reasons why I wrote the book, and one of the reasons why we host our show and when we talk heavily with our clients here at One Capital.
Yeah, it's kind of like the right path is the one that's the right one for you.
Yep.
I give a lot of talks to some trade industry groups, especially lately. The CPAs seem to like me. I think as I talk about math and probabilities, the CPAs seem to like that. But I was going through with them that even if you have gone through I guess I'll start over with that. Where really, if somebody gives you advice, they probably haven't actually done the math on whether their advice is right or not. And even if they did, they probably haven't done the math for you. So I think part of that of what's the right way or wrong way to go about planning for retirement. The wrong way is just relying on hearsay or, just kind of maxims, or just, I read an article and says this is a good way to go. The right way is doing the math that applies to your situation. And I think you wrote your book in a way that is easy to understand, but I can tell there's a lot of math and almost science, if there is such a thing of science behind retirement planning. You can tell that it's behind it.
Well, there is. And I mean, I think you and I both can, like we were joking at pre-production, right? We can talk for hours about this and all the planning we get to do for clients, but you're right. It's funny, math and numbers is a unique thing, right? Because it really, math doesn't lie, but at the same time, it can tell a false truth, especially if you're leaning on your neighbor's plan or maybe even a colleague, like within a certain, I have this a lot with clients where I'm able to be blessed to work with certain clients, and I have a lot of them within that same group of work, right? And so they think that with what goes with one goes with the other, and it's just not true. And I almost have to remind them that outside of these walls, within the confines of your office space or your work or occupation space, you have your own life to live with your own goals, your own objectives, your own family dynamics and structures. And believe it or not, all of those non-quantitative data points I just went through, or we'll call them qualitative points, are 50% of the battle. And I think most people only focus on the quantitative or the numbers only. And I think when you put them together for you, specifically for you, you end up helping you yourself understand kind of what your goals really are with your money, because it might actually be different than what you thought it was, because your friends had some plan built, or you've been talking to your neighbor at a barbecue, you know what I mean? And they got a product, or they have a solution or a strategy or something like that. And you're like, oh, that sounds pretty cool. A good advisor, I think, will sit down, go through a discovery process with them and make sure that that's right for them, to your point, right? It may be right for somebody else, but it may not be right for you. So securing the right path for your retirement is really an individualism aspect for you and the family dynamic and the goals.
Yeah, it's interesting you mentioned how you've got a lot of clients that are in a similar professional. So they kind of feel like, well, whatever happened for my buddy is going to be happening for me.
Right.
And that's just absolutely not true at all. We have a lot of clients through a company close by to us in Wisconsin called We Energies. And so it's a utility company that has corporate plans and union plans. When I read through the summary plan description, which is an important thing, I would hope that your advisor is reading through the summary plan description, which is kind of the rules for your pension and your 401k. But I'm reading through that. It mentions 13 different ways that things were basically almost calculated and promised out between the different unions, and when did you start and what's your predecessor company. So you might have worked next to somebody for 20 years. And I've seen this. You basically work next to somebody for 20 years,
Yeah.
and they're in your same department. And you think, well, whatever worked for Sally is going to work for me. That's not the case. You got to really look into it and see how it works for you.
Yeah, I have the same experience. One of my larger clients is in the Los Angeles area here, the LA City Fire and Police Department. So I work a lot with first responders, and that's a passion of mine. I've loved it for over 15 years, specifically working with them. But even in that same group, they have different tiers to what you just alluded to, right? So for me, understanding their 457B plan, which is the deferred compensation, that not the non-qual deferred comp plan, but the qualified deferred, which is already I got to educate them on that, because they'll do some Google research and figure out that most deferred comp plans are non-qualified. I'm like, whoa, wrong plan, right?
Right.
But they'll think of a guy that they were in the drill tower with, for example, or something like that, and getting on the job, but they have different careers beforehand, or they're in different what they call tiers, and you can elect to be in the different tier structures. And so there's just a lot of moving parts to it. And I will say this: the good and bad of that is they'll initially think that what worked for Sally would work for me, concept. Then when you were able to bend their ear a little bit and just show them, then it kind of spreads like wildfire, pun intended, here on my group, but it's like, you're able to kind of see a little bit of like, oh, you know what? Yeah. John and I is totally different because he had more time on the drill tower, or he bought his drill tower time back, or so on and so forth, or he's on the hazmat team. I have a USAR bonus, or all these different things that come out around that affects their pension, affects their contribution rates for deferred comp plan potentially. And so even a person who got on the same day and retired the same day in these examples we're making, right? Even if they were the exact same numbers, the plan is still different because of those non-quantifiable data points, right? Because outside of those walls, they may have a spouse, they may not. They may have multiple kids, they may have one kid or no kid, right? So there's still these qualifying factors, I think, that come into building an overall holistic wealth management plan or wealth forecast for a client, that really is individual.
Yeah, well, I appreciate the nerding out here about especially pension calculations. Before we do that, and I don't think we need to bore everyone too much on that.
Sure.
They know that we look into it, but just tell us more about yourself and how you got into, especially working with clients that have pensions, especially.
Yeah. I'm a unique case. I've shared this a bunch, and it's right or wrong. I'm not sure which. I'll let you guys decide, but I've never flipped a burger in my life. God touched my heart when I was 16 years old. I think all of us in our behavioral financial DNA, whether we know it or not, I try to walk it through with my clients, but there's really like two forms, right? There's like the God-given DNA, like no different than the color of your eyes. Then there's the circumstantial, the stuff we live through. And for me, when I was 16, my dad had worked for a telecommunications company for over 20 years as a salesman. It went through different iterations and was public at that time. And he was a company man. He made good money, but most of his value or his net worth was being built up in the acquisitions and the stocks as they were growing. And when I was 16 years old, I had two younger sisters at the time. I'm just about to get my first car that I'd saved up for, and his company went bankrupt, like almost overnight. 3 days later, we were, selling cars, moving things around. I mean, it was, even at 16, my dad shielded it from us, but I could tell, I was the oldest. I could just kind of see what was going on. And I'll be frank, looking back, I thought I knew the world, but I didn't. I kind of walked into a bank locally and was kind of mad, and just honestly, I blacked out. I just asked them for a job, and I got a job as a teller at Washington Mutual, God rest its soul. And just started from there. I basically started my practice when I was 18 in college at undergrad, getting my economics degree, and worked for a broker dealer for about 6 years, and then had to pull myself out of that and came and joined the group over here at One Capital about 13, 14 years ago. And it's been a great ride. And the entire time we've kept the main thing, as they say, which is clients. And I'm happy to say, when I came here, there was like 6 or 7 of us. We had about 560 million or so under management, and we're now at just under 100 people in multiple offices and just over $5.3 billion. And it's a prideful aspect of us, because it's not necessarily the number of the assets, it's more the clients and the households across the nation that we get to serve. And so it's been a blessing, and that's a very fast, down and dirty background on Brad Barrett and his financial advisory journey.
There you go. Well, you mentioned basically how the money aspect early, just realizing how much money can affect the non-money parts of life, even maybe education or access, right? You're talking about getting a job at a bank, just the education about different parts of how money works is huge, which is probably why you're so educational with your books and in your podcast. And you had a great educational piece, kind of just a description of how the market moves. You talk about the color of money. Tell me more about that, and how you can apply the color of money to, I guess, how you go about retirement planning.
Yeah, and usually when I speak about the color money, it's kind of funny. I don't mean the green aspect of it. It was a color coding environment that I learned early on with my clients as I was trying to. I'm always sitting in the seat, and like you, Jeremy, I'm sure, where we're trying to make sure that we meet the client where they're at, right? Because I think a lot of advisors can come in and try to talk at them or above them about this, that, and the other. And the reality is, we have to sit kneecap to kneecap and truly understand their background in a discovery meeting to figure out where they're coming from in their context of money. And the color of money for me was just born out of that. I mean, it was color coding in terms of like the growth, the preservation, the liquidity. I labeled it, red for growth, and the way we kind of built that was simply allowing in our plans kind of a color coding of saying, okay, this is set aside for growth. This is set aside for preservation of capital or fixed income orientation or items that will ultimately provide a stream of income. And then obviously the income stream itself. And so that's essentially, one item that I wrote in my book around, the color of money and how to use it. I mean, there's other ways to use that philosophy as well. There's the bucket theory, the bucket planning, right? You have 3 buckets, one's short-term, one's midterm, one's long-term. And you can, with the client, define the time period within each of those buckets. So it's just a great way to meet the client where they're at in their initial start of their journey of cash flow planning, and then ultimately bridging the gap between a well-designed wealth forecast, which encompasses your cash flow, and then into your, the real question is, how are you building the engine that's going to drive this vehicle, right? Because that's the portfolio structure. And for you and I, as we know, we want to diversify, not just within the asset classes, but also within the assets that we're investing in for the range of returns and sequence of returns we're trying to get, and the risk management we're trying to do for clients, because that's really what we are, right? We're risk managers. And I think it's important that our clients see it that way, especially as they get towards retirement.
Yeah, when the 3 you put in particular is that growth is red, liquidity, kind of availability is yellow, protection, which is kind of more on the guarantee side, is blue. I love that kind of picture drawing. I'm pretty sure those are the primary colors. I could be wrong. I'm not the
They are. I
artist,
have
but
an 8 and a 6-year-old. So 2 years ago when I was writing, I was kind of thinking as I was teaching my son Brooks, the primary colors, and I'm like, you know what? I'm going with that.
that's a good call. Okay, all right. So red, yellow, and blue, and of course they mix together too. I had another advisor share with me that he tells people when it comes to investments, you can get growth, you can get liquidity, you can get protection. You can only get 2 out of those 3 in one account, right? So that's kind of the way he explains it. Of if you are, there's nothing that's going to do all 3. If someone's telling you that here I've got this perfect plan that does all 3, well, they're pulling one over on you. And perhaps that's why you talk about the planning, where you kind of put it together in a tapestry of you. You probably shouldn't have all in one color. Pretty much be a boring picture there for you. But
Or
putting
you want to be
together
able
the right
to,
color of it for you is the way to go.
yeah, and you want to be able to, at the right stages, as I call like the seasons of life or the ages and stages that you're in right now, you want to be able to color code them appropriately, or I guess weight them or allocate them in the right order. I mean, we know this is a rule of thumb. I'm just going to throw it out there, but like you might weight my red color of growth more in the portfolio when you're younger, and then kind of lean more towards the blue, having liquidity, the yellow along the way, but lean more towards the blue as you get older. And that's a fine notion. I don't debunk that, but it's also kind of putting it in context to where you're at. I mean, right now is a great example when you can go get risk-free rate almost at over 5% right now for the time being. And so you have these interesting updates, if you will, to investment management out there. And I agree with that person. I think, I have a lot of times seen products in particular sold like they're the end all be all, like they're going to solve the world's problems when it comes to finances. And obviously being a seasoned veteran, in my opinion, I'm like, yeah, I'll challenge that a little bit. And I think it's just important to understand that this world can be subjective, and our job is to make sure it's objective for the clients.
Yeah, you said something about kind of putting things in the right order. And I'm looking through the order of how you put your book together. And I think it was on purpose. One part I liked especially is that you put this chapter called retirement income. So like, how do you get your social security, your pension, things like that? You put that first before you start talking about retirement assets like 401k and IRA. I'm just guessing that's intentional, because I'm sure it's like this for you. When someone walks into my office, they're usually saying, how much money do I need to retire?
Yep.
And a lot as if like, do I need the million or 2 million, or what's the right number? And really we're trying to flip it around to them saying, well, how much income do you need to retire? because it's interesting. You live your daily life with your income. Every 2 weeks you get a paycheck. You live your daily
Mhm.
life and your income, but somehow you think that this big pot of money is what you need for retirement. So I'm guessing. Tell me if I'm wrong. Is the idea of
No, you're spot
focusing
on.
on your income first? Okay, tell us about that.
Well, no, and you nailed it. I mean, as an advisor, especially as you see it year over year for nearly 2 decades, you realize that the number one question people are trying to understand is how much do they need to retire? And that question really isn't around a fixed amount. It's actually around a periodic payment every month, because your income, when you figure out what your need, and I always kind of categorize it like this, and I talked about a little bit of needs and wants, right? And it's really simple in a budget. And I don't really particularly like the term budgets when you talk about cash flow, because I think budgets can be a motivational thing, but it's not really something that'll last. So it's really looking more for like the phases of your cash flow, right? And what you're looking for over time, patterns, if you will. So as you realize, like, hey, I got $5,000 a month coming in on Social Security and pensions, and I got $8,000 a month going out, and how I want to live my life based on everything I provided. Well, we know there's a $3,000 difference that has to come from somewhere because you're not working anymore. We multiply that times 12, you get $36,000. Then we start the conversation of, okay, there's your income, which is why I led with that chapter first. If you know your income, then you can very easily, you and I can do this in 10 seconds of back into, right? How much, answer the question that they think they want to know, which is true, but they want to know it in a different way, which is what's your income first, and then we'll get to what the asset base needs to be. And that largely has to do with historical distribution rates, withdrawal rates that are studied empirically every year, as you and I both know. There's different numbers out there, but somewhere between 4 and 5% is a good withdrawal rate to have as your retirement. So if you take that $36,000 a year example I just made, and you kind of roll that back up as a numerator to denominator scenario that we all learned in 3rd, 4th grade, all of a sudden you get to around $1 million. So it's not that we chose $1 million out of nowhere. It came from their income, right? They had 5 coming in, they needed 8, they had 3, a difference of 3, get that on an annual number of 36,000, and there you go. And so it helps them see that income needs to start first, because that's the real generator behind the wealth. Some of my clients, and I'm sure you've had this experience too, realize that they actually are making enough in retirement to actually live how they want to live. So the question more becomes around not how much they need to sustain their life, it's more what they want to enjoy more of their life, and I think that's a really important aspect. And I think for anyone out there, one of the things that we share as financial advisors a lot is, we can only help you if you come to the table, but a lot of people don't want to come to the table for various reasons. One, they don't want to look at it. They don't trust advisors. They think they're going to sell them something. I think it's really important that they know that we're not. We're trying to actually solve a problem. At the end of the day, we're problem solvers around the concept of money. And I think a lot of times we have this notion, whether it's from marketing or how you were raised, that money needs to be looked at as in terms of like a lump sum dollar amount. And the reality is it's what the money can do for you, which is where your income comes in. And that's where you then get into the diversifying your assets relative to my color of money analogy. And then ultimately, what it's going to be paying you, and then understanding the sustainability of that. And it can help answer and solve a lot of questions that many people have when it comes to retirement.
Yeah, you just mentioned what can money do for you, and I think it's almost like that doing word. I'm going to turn that into like doing involves like action and taking control. And I think
Mhm.
that a lot of times the thought is, well, I can control what's going on with my assets. I can control with my stocks and bonds and interest rates. I think
Yeah.
that's completely bogus. You can't control what's going on with stocks and
Yeah.
bonds and interest rates, but you can control your spending,
Yep.
and even a lot of times you can control your income. If you hit retirement, you just retire today, you're never going to work a day the rest of your life. You have a lot of control over how much comes in from your Social Security, because you can
Yep.
choose how to take your Social Security.
And there's
You have very
there's
little
tons of
control.
options too.
Yeah, you have very little control of your assets now, because you
Yeah.
you can't put more money in. You're only there to take the money out. So eh, the encouragement, I think that's why you put the retirement income in there first, is focus on the things you can control. Like you said, keep the main thing,
Yeah.
and the income and your spending, those are the main things. Those are the things you can control. And then the assets are there just to fill in the difference, right? You hope you have
Exactly.
the assets. You can't fill in the difference if you don't, but they're just there to fill in the difference between that income and spending
But
deficit.
it also gives, if you don't have the assets to that point, right? It's not to deter you and say, oh my gosh, you're not going to make it. No. It's actually the opposite. It's the idea is to incentivize you for the actual goal you're striving for. We know this as advisors, but there are so many people walking around. I call them the mummies. They're walking around kind of like mummified, just kind of going through their day of, oh, I think I'm doing right. I'm doing a diet maybe, and that's doing one thing for a couple of weeks, and I'm going on a budget for like a couple of weeks, but nothing's like everlasting for them, right? And I think it's important to kind of for us to help them snap out of it, which is one of the reasons why we do our shows, is to kind of just get out in the community, get out in the world, and be like, hey, snap out of this. You got to like really look at this and just be like, if you're in the camp that doesn't have the assets, it gives you a goal. We can help you with the number to get to that goal so you are secured. And then it also ends in the other group, hey, you do have the assets. You can retire sooner than you thought. Like, both are good outcomes, right? And I think in the first camp in particular, the earlier you do it, obviously, the better it is. And that doesn't mean to say that someone listening or watching here who's 65 years old, who has a shortfall of income but doesn't have the assets, that we can't get them there. It just needs to have a conversation to figure out what that number is and how far off are we. And I'll end my little rant there on this, is I always tell clients, to your point, Jeremy, like money is a great employee, but a terrible boss. And I think when we start framing what money can do for us in that light, yeah, if you realize that you're being controlled every day by money, you're not really free, right? This whole movement of financial freedom, financial literacy over the past 5 or 10 years, which is great, I think, but making sure it's done right. If you're working for it instead of it working for you, you might not be in as control as you think. And the one certain thing we know in life is there will be uncertainty. So we want to make sure we have some stuff put aside. And we also want to make sure we know where we're going. My one analogy I always say is, when's the last time you got in a car and drove around aimlessly? Like, think about it. It's crazy, right? But we're always going somewhere. We're going to pick up our kids, grocery store, office, work, wherever, right? That's how you should look at your money. You should have the destination in mind. And if you don't, seek counsel and make sure you find that, because that's what's going to help you actually succeed in it.
Yeah. You talked about seeking counsel. I'm going to ask you there, how would you go about finding a good financial advisor?
That's you and I could talk about that for hours, I'm sure. I always break it down to 3. I think 3 are key components you should look at. And these are not in any order, but one is experience. I think finding the person who has a background in this, who has a passion for it, who has some experience in it, I think matters. I think in this camp, you also want to make sure you find maybe a specialist rather than a generalist, in your specific field. Like, for example, your clients at that company near you, they know their SPD really well, their summary plan description very well, right? So they feel there's experience with you in that. Same thing with me, with my clients in the city of Los Angeles. So there's experience is number 1. Again, not in any order, but number 2 is credentials. You want to find someone who's actually investing in themselves, CFP, CFAs. Those are important designations. I do say here, be careful of alphabet soup. You find the guy with like 50 letters behind their names, and I'm no shade to them. That's great. I just, sometimes they become a little more, in the books than in the world. And I think that's important. Just make sure it works for you. It could, that's great. And then thirdly, I believe in independence. I just think it's a natural way to share with the client that you're sitting with them. And I don't believe that individuals at independent broker dealers or at wirehouses can't act this way. I just think there's an easy way to go about finding an independent who doesn't have a boss or anything like that. So independence, fiduciary credentials are great ways to seek that. In terms of actual operations, I always say you should interview a few and ask those questions. Find some local ones. CFP.org, the Certified Financial Planning, they actually have a locator on there for those that are CFP, but I'm sure there's other ones out there as well. And so those are some resources people can look to find them, and then also kind of help to qualify them, if you will.
Yeah, when you're interviewing a few, ask all the questions. There's plenty of places you can find. Here's a list of questions that you should ask a potential financial advisor. Usually, what happens for me, tell me if it works for you this way for you, Brad. But someone will come into our office. They'll pull out a list of questions. They say, "I've got a list of questions to ask you. I'm interviewing a few people." The first question they ask is, "Are you a fiduciary?" And we say yes. And they say, "Okay, thanks." And then they fold up their list of questions and kind of put it back in the pocket. They hold on a second. Like, you took the time to get 10 questions, and virtually everyone's going to tell you yes to a fiduciary, whether they should or not. Virtually everyone's going to tell you that.
Yeah, that's a separate story.
Yeah, just ask your questions. So don't just stop with that one question. That's a little pet peeve of mine, that you might have taken the time. You're interviewing some people, and you feel maybe embarrassed. I don't want to ask you a bunch of these questions. Hey, you're paying them. You're about to pay them a lot of money. Go ahead, ask the questions, make sure it's the right person, and go beyond that quick yes or no of are you a fiduciary?
Yeah, that's the biggest thing is absolutely don't be shy to ask them questions, because the good ones, I think you and I love them. In fact, like you said,
Yeah,
if I had
bring
that,
it
I
on.
haven't had that, but if I did and they folded it back, I would absolutely say, look, I would love to answer the other 9, because there's obviously you spent the time looking at it, and I think it's important because you are seeing others. It's important to make sure you kind of, again, qualify how each are answering them, and what that means. I mean, the word fiduciary is an interesting one, right? Because it's a total buzzword now,
Right,
but I've been doing this for so long, so have you. It's kind of like, it's funny when that came around. It's like we've been doing that since the get-go. Why is this all of a sudden a thing?
right.
But there's a lot of bad apples out there who aren't, and so now we have to kind of create these terms and these best interests of client contracts, which is all good for the client. So I'm all for it. But I think you're right. Virtually everyone will answer that, even though whether they should or they should not. And I think it's also good to look at. You can ask them for things like their ADV, their backgrounds. These are all things we have to provide to them anyways. We should be providing to them, and it'll tell you a lot about a person.
Right on. Good.
Yeah.
Well, one piece you put in your book is about Social Security, and you've probably done dozens of episodes about Social Security on your podcast. As well, too. So I'm just going to ask you if there's one thing you could tell someone about their Social Security decision, what would it be?
So I always answer this question. It's not going to be very down in the dirty weeds. So if you do, check out your podcast, check out mine. But it's going to start here, and that has to do with that is anything around Social Security. It's so wise to seek. I know this is gonna be like a total vanilla answer, but seek counsel first. Like that's my biggest advice, because there are so many different options. Some options have been removed. There are varying different degrees of how you can use it based on your specific situation. I've even had recently a couple very unique situations that have come through recently with divorced individuals who happen to be 6 or 8 years younger than their spouse, who happens to be taking it. They can qualify for certain things they didn't know they could. There's just, so without even going into the deep depths of it, right, is find that person that you can talk to about something as important as Social Security, because it's important to make sure you do it right, because once you do it, you can't redo it. So that's probably my lead advice there.
Yeah, when we talk to people, we tell we're not going to be your therapist, but we have to ask you about your past relationships
Yep.
because there's a lot of things that pop up. You already mentioned the
Yeah.
divorce situations. There's so many things that pop up that you might not have been aware of, and unless we're asking you the question, how do you know about it? How do we know about
And
it?
she was elated because she was very open with in the discovery meeting. She was a referral from a client. She was 54, he was 63. And I'm like, hey, and she had no idea. And in this specific situation, it wasn't very amicable. Let's put it that way. So she
Right.
was left with not a whole lot going on. And so she walked out almost, she was in tears. I mean, and it was
I believe
literally, it
it.
was no more than us just walking her through her option that she had no idea she had. So again,
Mhm.
my best advice is, and I'm not saying it's going to happen for everybody, but like, you want to make sure you know what you're able to receive, and what you qualify for, and how that works within your, again, because remember, Social Security is a big part of your income, which is a
Yeah.
lead part of my book and a lead part of our how we talk about retirement planning. That's almost the spearhead, if you will, into lifetime income and how that works for your overall plan.
Yeah, another piece of Social Security, I think, is that when you approach it, you should really think of what is it you're trying to solve for. And my encouragement is to solve
Mhm.
for trying to make the most money of your lifetime, not the most money of the next month.
Yeah.
That's the way that Social Security ought to be approached.
Yeah, and it's hard too, right? Because everyone looks at that 70, and they think,
Yep.
oh, if I just wait. And I'm like, I always, and this is right or wrong, but I always tell people, like, if we can have the conversation with the holy above, I could have a financial plan dialed in so well that you'll have your last $20 for your last in and out double. That's a big thing here on the West Coast, right? It'll be so fine tuned. And even into things like Social Security, like if we know how long you're going to live after 70, as an example, then we can run the mathematical analysis based on that. But one of the best gifts he gave us was obviously that we have free will and we don't know. So it's challenging, obviously, from a planning standpoint, when you have some assumptions you have to make, to your point. But I think it's really important that you walk through those assumptions and help, quantify those for yourself with a trusted individual who has experience in that. Absolutely. And yeah, it's sometimes we are the financial therapist for them, kind of walking through, because past relationships come up as the circumstantial evidence for how they
Yeah.
look at money in different ways. I talk
Right
with
on.
clients all the time about that.
Hmm. Well, I've got one more question for you, Brad. Before that, tell us what's the best way to get a hold of you?
Probably our website is probably the best. Our firm, One Capital Management, our website's onecapital.com. I think a great way is our YouTube channel. We have weekly shows. We talk about all these kind of topics. It's actually called Make Your Money Matter with Brad Barrett. So you can find that on YouTube. And again, as old school, you can always give us a call. Our number here is 805-409-8150. We have offices mostly in the West Coast, but Kansas and Toronto. So we're all over the great states, as well as up in Canada, our brethren up north. So, yeah.
I like it. Well, and of course, we've been talking about your book. I'm going to put some links to your book in the show notes. So if you like the ideas that Brad's talking about, you can definitely check those out. At the same time, we love giving away books. So the first 3 people that email me, podcast@keilfp.com, we'll send out to you a free copy of Brad's book. So make sure it's quick. Get on your email there. Pull over if you're driving, right? And
Yeah.
we'll get a book out to you. Awesome. Well, thanks, Brad, for coming on out. Our final question is: tell us something about yourself that few people know about, and remember, this podcast is ready to clean.
Most people don't know this, but having 2 younger sisters and being raised by my mom mostly, I will say this: I am very into theater. I went and saw Les Mis the other day with my sister, and we absolutely loved it. Both my sisters and my dad actually were in children's theater groups. So kind of one of those sports nuts who people don't realize actually has a heart for theater. So that's something most people don't know.
Well, that's great. Well, appreciate you sharing that, and of course, coming on the show and teaching us
Yeah.
all how to retire right.
Oh, I appreciate you having me. Thanks again.
Yeah, thank you, Brad, and thank you for listening to the Retirement Reveal podcast. We believe if you know more about your money, you'll feel better about your money, and you will make better money decisions.